Hey guys, welcome to another webinar by Kazob. I'm the founder of Kazob Career Solutions. My name is Advait Dandekar. And what we're trying to do is we're trying to bridge the gap between what's taught in college and school and the skills and knowledge that is really required in the industry. And we do this by simply broadcasting interviews of people from the industry. And actually today we are going to be talking about stock market trading with data-driven decisions. And though this particular webinar is primarily aimed at students who are in financial markets, since stock market trading is followed by most people, it will hopefully be useful to even others. So with that, let me introduce our speaker, Chaitanya Patwardhan, who is the co-founder and chief strategist of CJVP Capital. So hi Chaitanya, thanks a lot for coming.
Hi Advait.
How are you?
Yes, good. I would like to thank Kazob and all the people who have registered for this webinar.
Okay.
I'm going to share all my experiences as of now with my algorithm and the other things related to the market.
Okay, great. So can you start by talking about what it is that CJVP Capital does and something more about your company?
Right. So I would like to share a slide here wherein we'll speak. I can explain you more in detail.
Okay.
So we CJVP we started somewhere in 2005, and we are certified brokers with NSE and MCX exchanges. We are platinum category sub brokers with angel broking, and we started designing the algorithm since 2008. Especially post the big market crash that was happened in 2008.
Okay.
We specialize now in bullion trading, especially in gold and in silver. So just coming to the so these are the current investment options available in the market as of now. Now I'll just explain you why we started with the algorithm thing and just a brief introduction. These are the options available. We have a mutual funds, and we have you can do a SIP in the mutual funds. Then we have direct equity. You can have a demat account and you can trade your own money and whatever. Then we have commodities where not many people are comfortable trading in commodities, but still there are a few individuals who trade in commodities. And the rest we have the bank FDs, we have the recurring deposits, we have real estate, which is actually where the major chunk of the investment goes for any individual. So if you see all the above investments that are available in the market are all long only investments, right? When we say long only investments, that means investor will make money or will be profited from the above investments only when the markets are going up, and not otherwise. So so he has no control over his investments if the markets are going down. Now here is where we started designing the algorithm in 2008, specifically 2008, because 2008 was a learning experience for a lot of investment bankers and other people who are trading in the market. So what happened in 2008 is that there were a lot of issues like Lehman Brothers went down, etc., where the markets were going down and the people who were invested, they were long only, the mutual fund NAVs went down, etc. And then the people didn't know what to do with their investment at that given point of time. And that is how we started developing the algorithm RM3, which is basically a hedging strategy.
Okay. Before we actually the investment philosophy and all the knowledge that you have to share with us, can you just lay the foundations by talking about the current market and the future trends?
Yeah. Okay. So we have. So now the current global issues related to financial markets. So we saw so Brexit was like the recent event that happened in the market. So Brexit was a very unique case where UK wants to get out of the EU, and especially because of the regulations. Now, there are a lot of things that we can go, like we can explain Brexit, because Brexit has a different perspective, because everybody has a different perspective on the Brexit. So Brexit basically is mostly it happened because of the migration issue that is happening in the EU, and obviously a lot of other things, but migration was also a major issue. Simultaneously, the ECB was printing more and more of the euro, which we call them like quantitative easing. So if you see on the right hand side are the currency wars. So everybody is trying to devalue their own currency just to make their trade with the other countries easier. But the problem is that every time you devalue a currency, you're also losing your existing investments. The values go down, etc. Right? So we have the Brexit, we have the currency war, then we have the EU migration, and EU migration can also be there in other countries. Like Donald Trump right now in the US is also fighting on the similar lines, wherein migrants are working in the country, and now the country has to take care of their own people other than the migrants coming in. So
Yes.
all these are like the current issues, and hence we are trying to find out a solution on how to take care of these major global issues. How do you find a solution to it, or how do you trade accordingly?
Okay. Um, can you talk a little bit more about the currency?
Right. So the currency war is basically everybody is devaluing their own currency just to make trade easier, and simultaneously, not many people know of quantitative easing. So quantitative easing is basically the printing of money at will. So only a few central banks like the dollar, the yen, the yuan, the pound, and the euro, they have the permission or the right to print to infinity. So the quantitative easing is another issue that we are facing, and hence zero interest rate. Then interest rates are going down. We have to see how, because if interest rates keep on going down, then I don't think we have a very decent future ahead. And same with quantitative easing. If you just keep on printing money, it's not going to solve. You don't print money to solve issues. The country has to be productive enough to solve the financial issues in the country or in the economy.
Okay. So can you talk a little bit more about your investment philosophy and the algorithm that you actually used? Because for the students who are from financial markets, it would be something new for them. It would be something that they could probably implement in their work. So can you talk some more about your RM3 algorithm?
Right. So we'll come to the point where the reason we designed an algorithm is because so I'll just share a slide here. Yeah. So why predictive algorithms? We have to have a reason behind designing an algorithm, right? So
Right.
the first point here is the discipline. So you ask any trader in the market, or experienced trader in the market, and he'll say that the only reason he lost money in the markets is because he didn't have a discipline. Because the way we see discipline, so discipline and consistency are one of the most important things we need to trade in the market. So once you have the discipline, then you have to consistently stick to the discipline. And when you have an algorithm, then the research is not biased, right? When you have numbers playing the game, that is the time nobody is in control. So we don't want any human intervention in the algorithm, and hence we started. So you also can ask professional traders So what exactly happens when they panic? So we don't need panic, we don't need unbiased, we need extremely good consistency, and we need very high level of discipline while trading in the markets. And hence we started designing this algorithm called RM3, which we call it. And what this algorithm does is basically we have identified a relationship between gold and silver uh, to the Nifty and to the
Okay.
USD INR. So basically what this algorithm is doing is that we have gold, silver as the bullions, which are also considered the currency of the world. It's like gold and silver, you can go anywhere in the world and you can trade this for food, you can trade it for anything, right?
Okay.
So we need gold and silver is our major the currency, and we try to find a relationship, or we don't you try to we've already identified it, we just try to enhance and you find out how the direction will be if gold and silver. So let's say if gold and silver are going up, then we try to see where Nifty and USD INR are, or in which direction they will be moving. So when we say
Okay.
we have a predictive algorithm, that is the time when
Mhm.
gold and silver, we are trying to identify where Nifty and USD INR also are moving. Because what we do is that, let's say we have XYZ amount of corpus with us. We are distributing gold and silver, and we are also trying to manage the rest of the Nifty and the USD INR. So
Okay.
if Nifty is not performing, then we try to give it gold and silver more weightage. If USD INR is
Mhm.
not performing, then we try. So it's like let's say a dynamic thing that we do, but we are continuously trying to identify. We have a live feed. I'll be able to show you right now. We have a live
Okay.
feed here, wherein we are taking live quotes from the international market. So when we are going to trade gold and silver, we are taking the dollar rates, the international rates at which they are trading, and hence these rates are, so these are the live feed. You can see how gold is up in the last 2-3 months. Silver is also up. We are also identifying where exactly the trend will go. We have stop losses placed above and down as per our trade. And with this live feed, our algorithm RM3 is trying to identify in which direction gold and silver or any of the other two instruments like Nifty and USD INR are going to move. So that is the whole intent of the algorithm, to identify the direction.
Okay. And I guess that's also a good way of managing the risk, right? So can you talk a little bit about how the RM3 algorithm actually uh, uh, how it manages the risk?
Correct. So now we have two different ways to manage the risk. Okay, the second one that you see on the screen, the RM3 strategy, is usually not. So if you ask any professional trader in the market or a very experienced trader, he'll exactly understand what we are trying to explain here, and also to individuals who are trying to learn. Okay, so we have, so one basic rule that we have to follow while managing risk is you cannot have a lot of positions in your basket or in your portfolio when the markets are against you, right? That is the worst thing that you can do. And the only reason is that when the markets are against you, you have to find out the immediate possible way to get out of the positions, not get in the positions. So now let's see what the first standard practice is. The standard practice is people try to sell when the market is going up. So let's say I have something. So let's say I have bought a stock XYZ for, let's say, rupees 100, and the stock goes up to 110, 120. Now a normal individual, a normal trader will start booking his profits, and he will slowly get out of the trade. Now if you see in the
Mhm.
standard practice, when you start selling profits, you start losing all your positions. That means you are coming out of the market not inside. So this is the time actually when you should be inside the market, not outside, because the trend is in your favor. On the other hand, if you see the RM3 strategy, we are going to add positions when the market is in our favor and not the other way. So here, in the standard practice, people start averaging when the markets are against them. So let's say we have, so let's you take the same example where we have bought a company XYZ or anything that we buy for, let's say 100, and the price keeps on going down 90, 80, etc., etc. That is the time people start averaging. They buy at 95, they buy at 92, 87, 70, and what if it goes down to, let's say, to 50? So they have more risk in their portfolio when the markets are going down, not necessarily going down, but when the markets are against them, right? So you have to make sure that, so this is what we do. So we have learned it the hard way. In the RM3 strategy, basically will get rid of the positions. We will start reducing up positions when the market is against us, and we will add positions when the markets are in our favor. That is the most safest way to stay invested, because you are going to add more money in the market when you are in a profit, not when you are in a loss. So this is, so that is what we do. That is what the RM3 strategy is.
Okay, great. So actually, that's a pretty interesting scenario in which you're doing opposite of what the standard practice is. So I think this is a good poll question that we can do for the viewers. If you just scroll below the video embed, you will come to a poll question. So please do send in your answer. We are basically asking whether you believe in the standard practice or you believe in the RM3 practice. And even if you aren't already investing in stocks, you can still give your answer to what you think is what you would do. So if you scroll down, you'll come to this poll question. If you could just answer and send in, and then we'll show the results at the end of the webinar or sometime during the end of the webinar.
Great.
Having said that, for the people who joined late, just send a message saying hi or something on the question tab so that we know you're here. And if you have any questions, just feel free to ask them in the questions tab. Okay, so Chaitanya, let's continue while we are waiting for the poll responses to come in. How often, or rather, do you have to measure the RM3 algorithm, and how often do you have to measure it, and how do you keep track of its performance?
So we need to track a performance for, obviously, for anything that you do. It may be running, it may be exercise, or it could be anything in your life. You have to make sure that until you have a record of your performance, that is the only way you know that you are either moving in the right direction or not in the right direction. So as we speak about how we measure the performance, right? So we do a day-to-day basis performance. As in, there is something called as mark-to-market, right? All your investments that are done. So we manage a very large portfolio, and we have a daily mark-to-market, which is called M2M. And this mark-to-market is what shows us if our strategy is working or we are not working. So we either have a profit on that day or we either have a loss on that day. So this mark-to-market is done on a daily basis by the exchange, and we get a report. And obviously, we know the terminal is in front of us, so we know by end of the day if we are in a profit or a loss. So it's very crucial for risk management. Once the market closes and we know what the mark-to-market is for that day, the next morning, we immediately, before the market opens, we try to make sure that we adjust our risk. So as I explained you in the previous slide, let's say we have a loss. We have a loss for that day. The next morning, we'll open our positions and we'll square off a few positions because we had a loss for the previous day. right?
Okay.
Even though so even though we are going to book a loss, we don't worry about the loss. We worry about the exposure to the market. So this is how we try to measure. So every day we open our position, we see if we are exposed in the correct way or in the right way. So we have a lot of instruments. So we have a lot of calculators that we have different formulas to see if we are invested in the correct proportion, because we have four instruments to distribute. We have gold, we have silver, and we have USD/INR to invest in, and obviously the Nifty. So we have to see where we are exposed more, where we are not. So it's very crucial for risk management. The measurement plays a very important role, and most important at our end we do on day-to-day basis. And most important is when the market straight away goes in opposite direction, we immediately have to square off our existing position and we have to take the negative or the positive side of it. So, so measurement is very important. And speaking about algorithm tweaks, algorithm needs doesn't need a tweak every day, right? But if there are any global scenarios that need, so let's say, I don't know if people know about the gold-silver ratio. Gold-silver ratio is a very important indicator. Market volatility is also a very big indicator when you are trading any of these instruments. And we make sure that we know where the gold ratio is, and accordingly we have to tweak the algorithm just to suit, because sometimes silver is outperforming gold. There are times when Nifty is outperforming silver. So as I said, we have, this works on, let's say, a relationship. We have to see where exactly what is performing, in what way it is performing. So we need to tweak the algorithm accordingly. So it's very crucial. Tweaking the algorithm doesn't happen on regular basis, but depends on the market volatility and also on global events. So this is how we try to, of course we can get much more in detail, but this is the most easiest way to explain right now.
Okay, great. So how did you come about developing this particular model? What kind of skills do you require to do what you did? And did you collaborate with anybody else in developing it?
So this has all been done by us. So we haven't called, because we haven't heard of anybody using a similar strategy anywhere in the market. We would love to learn from the people who are doing or using a similar strategy, but this is 100% designed and created at our end. So these are the skill sets that you need while designing an algorithm, right? So now I'll just take you. So when I started in 2005, I used to be a pure, let's say, a technical trader. Okay. So what a technical trader does is that he will see the charts. There are many indicators available in the charting software. So you have to be a good technical trader when it comes to designing an algorithm. Okay. And secondly, you need to know a little bit of fundamental analysis, that what is the global economy, what is the local economy, then sector specific. If you are going to design an algorithm for a specific sector, now if you ask me, my sector is mainly the bullion markets, right?
Right.
Then if you are from a specific industry, let's say someone from the chemical industry will try to analyze according to his industry. Somebody from the engineering, he'll try to see. So it's a combination of technical analysis and fundamental analysis simultaneously. Once you are training yourself and you are reading through a lot of books, and see, stock market trading, you can learn, but there is no single book that you can follow. You have to be your own guide somewhere, right? So once you gather information about the technical analysis and the fundamental analysis. Simultaneously, you have to also understand what exactly you want from the algorithm that you are trying to design, or from a logic that you are trying to do. So this is where the logic also comes in. So once you are aware of the technicals and the fundamentals, then comes your logic, and in a logic, this is exactly where you try to combine your technical and fundamental analysis, and it will give you. So this is how I have been developing, right? So I have had experience of the technical training, but I was not so successful. Then I simultaneously was doing the fundamental analysis, where I wasn't very successful. Then we started designing a logic. So I wanted to have, let's say, to design an algorithm wherein I know what I'm going to do on that specific day, right? Because everybody says once the market starts, that is the time you start taking the decisions. Yes, agree. You have to take decisions when the market starts, but there is also something going behind it that you should have. So we designed this, especially keeping that in mind, that we can't be completely dependent on what the market, how it opens, how it closes. So we don't work on historical data. We work on live dynamic data, which we are continuously grabbing from the markets. So we are also tracking the currencies. We are also tracking, let's say, by crude oil, because all these have effects on the dollar, the euro, the pound. Because and I being so, let's say, we being in India, it's not just the domestic market, because now we are all global. It's all interrelated. So you have to make sure that you also have to follow other, let's say, international markets and other instruments in the market.
Right. Okay. I just have one more question for you. For the students who are coming out of college, say who are studying BFM, or they are giving the NSC and BSc certificate exams, is there any kind of advice or something that you would give them? Any other resources that they should look for in their careers?
Right. So as I told you, you have to be very strong with the fundamental analysis and the technical analysis. Now you have a lot of books on the technical analysis, as well as on the other analysis that we discussed. What simultaneously you can do is that you can also go online, on YouTube, and just start understanding what traders do. Simultaneously, while you are doing this, please open a small demat account, right? What the small demat account, I mean small investment, as in, let's say a lakh, or let's say you can start with whatever you are comfortable with, and you start trading them. You have to know where exactly you are going wrong, why you went wrong, and what can be done to solve that. So this is how we do. So we started trading stocks initially. Since 2005 we started trading stocks. Then we moved slowly into commodities. We were not very successful then we started doing this, and then post 2008 is where I actually started understanding what is right and what is wrong. Once you take care of all the wrong things that are happening, automatically you end up in a profit. You have to reduce your losing trades, and you get into, and for that you have to keep on practicing, because I'm sure the guys who have there won't be any specific course available in the market, in the colleges who teach how to trade, because they can't take the responsibility. The problem is nobody is able to take responsibility to that. They have taught you to make money, and now that you are not. So you have to learn it in your own way, how you like it, how you understand your risk appetite. You have to identify and be more comfortable.
Okay, great. Okay, so I think we can take some questions now, and while we wait for the questions, I just want to share the results of the poll.
Okay.
So we asked the people, what risk management strategy do you follow? 46% said that they follow the standard practice, and 53% said they follow the RM3 practice. Are you surprised by that? Were you expecting that?
Well, yes, I'm surprised because very few individuals, and I'm happy to know that they are following the RM3 practice, because that is the most safest way to trade in the markets. So
Right.
it's a good. So I request all the other guys also to move into the and start practicing the RM3 way, because of it's more secure, it's more safe, and then you have to come out of your losses as soon as you can.
Right. Okay. Okay, great. So I think we can start taking the questions now. We've got quite a few. So we'll just take as many as we can.
Right.
So let's see. Okay, so from Neha, we have a question saying that, in your opinion, how risky is commodity investment? Are there guaranteed returns?
So now, once you have like identified a strategy or a way to do it, nothing is difficult. See, I'll tell you, the people who lose money in the markets, that will be commodities, that will be mutual fund. You have to be on your toes. Point one. Second is, you have to know your risk appetite. You cannot, and most importantly, you should know when exactly to come out of the trade. That is where everybody goes wrong. So ask anybody who's lost money in the markets. He'll say, I didn't get out of the trade, because everybody gets an opportunity to come out, but they don't. And that is where your skill set comes in place. You have to know, you have to be skilled enough to identify what is the right level to come out. Let it be a profit or let it be a loss. So there's no specific that commodity is risky and commodity is not risky. There's nothing like it. You have to have a good strategy. You have to have good risk management, and you have to have good research backing you.
Okay, great. So I think you touched on this question a little bit earlier. You can go into more detail. So Param is asking that, will the Brexit affect Indian markets? If so, how and when?
Right. So the immediate effect that you saw after the Brexit is the pound collapsing, and if you see the gold and silver markets went up, that means gold and silver are immediate hedge to currency, right? So we actually had predicted this. So even we had a long position in the gold and silver for almost 2.5 months, right? So post the Brexit, we obviously, the pound has collapsed. The companies or the specific individuals who are expecting payments in, they say, pound or anything related to the pound, obviously they are affected. And yes, we will have effect, and it has not started. The markets, if you see the Nifty, recently Nifty has gone up, which is not actually we are actually against that trend. We are actually neutral on Nifty right now. So we don't recommend a buy. So anybody who has a profit in Nifty or in stocks, anything to related to Indian markets, if you're in a profit, if your mutual fund NAV is higher than what you bought, or if you are okay to get out, I recommend you should get out of the market, because I personally and my algorithm we are expecting a fall anytime soon. So yes, Brexit is going to affect us, and there are going to be much more ruthless events than the Brexit in the coming future.
Okay, great. Next question we have from, and he's asking, how frequently do you change your algorithmic strategy with context to changing market conditions? But you said you do that on a day-to-day basis, right?
No, the risk management, we do it on the day-to-day basis. But the algorithm, you won't change. The algorithm will just indicate you where the market is going, but we don't have to do tweaks every now and then. We do tweaks only when it is required, and that only we will know only after the market actually starts happening. So you have to take a risk at that point of time, assuming that we are at a correct day. But again, as I said, we are going to reduce the positions when the market goes against us, right?
Right.
So
Okay.
yes, so risk management happens on a daily basis, but the algorithm is not tweaked on a daily basis. It happens
Oh,
once in a while, or maybe 6, 7 months, 8 months, once in a year. It could happen. You cannot actually say when we are going to do the tweaks.
right. Okay. So the next question is from Doyen, and he's actually asked two questions. So
Yeah.
I'll just ask them one after the other.
Right.
Uh, the first question is is RM3 automated trade still done by humans based on RM3 recommendations? And the other question he has asked, which I think is related to this, is how frequently does RM3 trade? Is it daily or weekly?
Correct. Exactly. So these are excellent questions. So basically, we have a combination of automated as well as manual, and I'll explain you why. The
Okay.
RM3 algorithm, okay, the RM3 algorithm is a completely automated process. But when
Okay.
it comes to trade, we have manual dealers. So we call them dealers. So we have a certified and trained dealers who are simultaneously uh, following the output that we get from the RM3, and then we are trading in the market. So yes, we don't have an automatic trading platform. We do it manually, and the reason we do it manually is that just if anybody knows about this, it's called high frequency trades. So
Right.
when the market is on, you see
Mm-hmm.
there are times where but it's very rare. It doesn't happen on a daily basis, but there
Okay.
are times when there are these freak trades. We call it high frequency trades that happen in the market. That is the time, if you have an automated algorithm that is trading on your behalf, then there is a possibility that that algorithm trades because there is a high frequency trade, and it does a wrong trade because the high frequency trade just does a trade and it is back to the normal position. So that is the reason why we don't do the trading is done manually, but research and everything is done. It's all automated by the RM3. And
Okay. Great.
second question was uh, sorry, just can you ask me the second question again? I forgot.
Yeah, sure. So the second question was how often does the RM3 algorithm trade?
Right. So we don't trade. So that's also another interesting question.
Okay.
Usually we don't try to we don't trade often. It is mostly in a month or maximum uh, once in a week. But
Okay.
this algorithm, the main purpose of this algorithm is to identify a trend. Once we have identified the trend, we
Mhm.
stick to our trade. We are invested, and we just wait for a reversal.
Okay.
So it doesn't trade often. It takes its time, and we have to see how the numbers move, and then accordingly we change.
Okay. Okay.
So it doesn't trade regularly. It is so we call it as a we say we are positional traders using the RM3 algorithm. We are positional traders.
Okay. Okay. The next question is from Abhijit again, and he's asking is how do you manage major gap up or major gap down opening in algorithm? Maybe for example, on Brexit outcome, there was major gap down opening.
Right. So I'm just so we are just proud to say that we actually expected the move the way it happened. We in fact made a very big. So it was a big day for us when the markets opened gap down. Equity markets opened gap down, but on the other hand, the gold and silver opened the gap up after the Brexit vote. And so what this algorithm does is that it is trying to go with the market. Okay.
Okay.
So we have zillions of traders in the market who are trying to trade the buy side, the sell side, the long side, the short side. So our
Okay.
algorithm on that specific day had already predicted that there is a possibility of things going up on the gold and silver side, and the possibility of Nifty going down on the downside. So my answer is gap up and gap down are predicted a day before by the algorithm, and it's a very important thing. And
Okay.
I really appreciate that. So this is a very interesting question that you asked. That so it's very important that during a gap up and a gap down opening, how does the algorithm react? So the algorithm has to react earlier. Then you actually have a right algorithm. It has to predict a day before.
Right. Okay.
So we are actually proud to have an algorithm which has predicted Brexit. We have predicted a lot of things in the history. We have a lot of trades that happened. We were invested in the right direction.
Okay.
So we don't worry about the gap up and the gap down the way a regular traders does.
Okay. 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 Hardik is asking, is the RM3 algorithm practice, is it viable for long-term investors as well?
It is a long-term investment. It's not for a short-term. It is a design. The RM3 algorithm is designed for people with a long-term perspective, but a long-term perspective simultaneously with a long-term perspective, you can measure and take your profits out of the market on regular basis. So it's a combination of a short-term strategy as well as a long-term strategy. You can also do on week-to-week basis. So the beauty behind this algorithm is that it is actually a long-term strategy, but you can take the profits out if you want on short-term, and that's very important. Unless and until you take the profits out, your strategy is of no use.
Okay. Okay. Great. So I think we have time for just two more questions, and they both happen to be from Achal. So the first question she's asking is: should the day traders in the market concentrate on a specific sector? Any recommendations on sectors?
No, so I think it's very individual. Whoever understands that sector more, I think you should research more on that.
Okay.
So I don't have any recommendations on any specific sector because it depends on what you know about the sector. So as I said, we specialize only in 4 instruments. So we read and study only about those instruments.
Okay.
You also have to do the same. So anybody knows anything about the, let's say, like as I said, somebody from let's say architecture, or let's say from a real estate background, he will follow real estate stocks and he will do the research accordingly.
Okay. Okay.
So no recommendations from my end to follow any specific sector.
Okay. Okay. Great. So we have just one more question. I mean, we have more questions, but we don't have time for them. So the next question is again from Achal, and she's asking: are there any algorithms available online that day traders can use?
There are, but again, they will not. So you again have to find out your. So there are algorithms available in the market. You can buy them, but your risk appetite is more important. You have to know what your risk appetite is, and then trade accordingly. So I would recommend whoever is planning to buy an algorithm, or if anybody is recommending a strategy to you, you have to make sure what your risk appetite is. Okay, so great. Once you know your risk appetite, once you know your entry exits, then it is okay. Then you should be comfortable with it.
Okay. Okay. So actually, we have quite a few more questions, but we don't have time to answer them. So we will definitely.
Yeah, I'll be able to answer them on email or in person.
Okay, great. So can you just share your contact details, Chaitanya?
Yeah, I will. I have a slide created for that. So if you want to note down, you can always just 2 minutes. And you can always follow our Facebook page, which is CJVP Invest. So all you have to do is search for CJVP Invest on the Facebook, and you will find us. And simultaneously, we also do a commentary, as in where we speak about our existing positions, and it's like a live commentary that we do.
Okay, so that's on Facebook.
Yeah, that's on
Okay, great. So actually, your email ID wasn't there on that slide. So can you just share your email ID?
Yeah.
Uh,
Yeah, it is cjvpinfo@gmail.com.
okay, so cjvpinfo at
So at
gmail.com.
gmail.com. Yeah.
Okay, great. So thanks a lot, Chaitanya, for coming. I
Thank you
hope
very
you
much.
come again.
Yeah,
And
sure,
it was
sure.
really, yeah, and I really it was really insightful. I hope it was useful to not just the financial market students, but also to everybody else attending. And to
Right.
the viewers, thanks a lot for attending. We really appreciate you taking the time and coming here.